Very well. Good morning to you all. I trust you are all doing well. And welcome to our very first lecture in management accounting for the July 2026 examination. I'll be taking you through the course for the next 12 weeks. And as we discussed in our very first meeting, that's the introduction and syllabus overview session, it is my hope that we are all going to apply what we shared, okay? And I want the session or the entire period to be as engaging as possible. So even within your group studies, you can see I'm joining your pages so that if there are any questions, you can forward it to me so that I look at it for you, right? Aside that, there'll be a lot of quizzes, okay? Just so you are almost always engaged with the syllabus content. So that is what we are going to do. So try not to be left out, okay? Try not to be left out, like we said. All right. Let's jump into what we have for today. As this is going to be the first lecture, it is just right that we begin with some introductory stuff. Like I shared with you on the first day, the paper is broken down into 3 themes, right? So let's recap a bit on that. We have the planning theme, right? We have the control or the controlling. What do we mean by controlling, right? And then we have the decision making. And so all the topics we are going to treat will fall under either of these 3 blocks, right? Once we proceed or once we are going through the topics, I'll be telling you where each of them fall under these 3 blocks. So this is something that you need to know or have at the back of your mind, okay, as we proceed. All right. The paper we are going to write is called Management Accounting. Now, it is a follow-up paper from an introductory paper, which is called Introduction to Cost and Management Accounting, right, in level 1. The examiner expects that whatever is in that level 1 paper, you have knowledge of. And so going into the management accounting paper in level 2, if you are being asked to apply any of the concepts over there, you should be able to do that. And so it's just right that we start from some very important level 1 stuff, which will help us in the level 2 MA paper that we are going to write. Okay, so that is where we are going to begin from. And so we just want to know what we mean by cost accounting. Okay, so management accounting has a foundation from cost accounting. Okay, so you need to know how to cost your product or what costing is. Then you can use that to you can use that information for your decision making and so on and so forth. So costing or cost accounting, as we will know it, is a system of recording data, producing information about costs for products which are produced by a company and for services that the company provides. So cost accounting in level 1 teaches you how to record data about what costs your company is going to incur if you want to produce a product or render a service. Then management accounting will basically take those foundational issues or take the data you have gathered under cost accounting and use that to do what? Plan, control, and make decisions. So at the end of the day, a part of what we are going to do in MA is to take cost accounting information to do what? To help us plan, to help us with control, and also help us with make decisions. We'll get to understand what planning is, what controlling is, and what decision making basically is. What does planning involve? Planning involves what? Setting objectives for the organization and then making plans towards what achieving those objectives. And that is demonstrated through the preparation of budgets for the company. Okay, so within the budget, you have what we call standards, or you have targets, right? That you have set for each staff or each worker, and you look forward towards achieving those targets. And so, in achieving those targets, you have to put some sort of uh, either financial or non-financial targets that needs to be reached, or what we call KPIs, right? To be able to gauge whether you are reaching those targets or not. So by preparing business plans, budgets, and sales plans, we basically see what we are planning. Okay, we are planning. All right. What does controlling mean? Or what does it mean to use cost accounting information to control or to perform the controlling function? Controlling will involve the following: monitoring your actual performance and comparing it with what the objective or plan or the budget which you earlier sought out to achieve. Okay, so what did we say we are going to do? What have we actually done? So within this paper, we'll be doing a lot of comparison between actual performance or actual activities as against what budgeted activities or our plans. Okay, all right. Then once you do the comparison, what do? You have to take control action where appropriate. So the appropriateness comes in when, after we have been able to detect what the difference will be between what we said we are going to do and what we actually did. And that difference is, quote unquote, a bad difference, right? So what do you plan for? You plan for your costs. We said for our production, we want to incur 10,000 as the cost. That's the budget. If at the end of the day, our actual cost for production is 12,000, then what has happened? We have overrun our budget. Okay? And so we will need to take the appropriate action going into the next period. We'll try to avert any budget overruns. I hope that is clear. All right. So that is where taking the appropriate action will come in. However, if the difference is a good one, then again, the appropriate action we can take is to try to consolidate that position, try to still maintain our cost, or ensure our cost remains low. I hope that is clear. So that is what you have to do. Then, once you are done, you can evaluate your performance. So in the first scenario I gave, if we overrun our budget, it basically means we did not perform well in that regard. We're not able to either maintain the cost we sought out to incur, okay, or even reduce it. I hope that is clear. So we can be able to assess or evaluate the performance of the company in that regard. And that is what the controlling aspect basically tries to look at. So performance evaluation, we are going to look at issues like that. Then decision making, very important. If the organization wants to take a one-off decision or probably a special order decision, right, we will need cost information. So a customer approaches us, oh, I want you to produce a one-off project or produce something for me. It's just one-off. I'm not going to come to you again, right? It's just a one-time thing. Before you decide on whether to go ahead to produce it for that customer, you first of all need to ascertain how much it will cost you to do that job. Okay? So by understanding the cost of doing that job, you can make a decision as to whether to proceed with that special order contract for that customer or not to do it. Okay, so that is just one aspect of it in using costs or costing information to make decisions. I hope that is clear. There could be also other things that we can use this cost accounting information to do, but decision making is also one of them. Then performance measurement sits between the sweet spot, okay, of planning and controlling. Okay, because at the end of the day, like I said, the end goal of controlling will be towards evaluate your performance or measure your performance. And what we said about controlling is that it is where we compare, right? What we said we'll do, which is the plan, and our actual performance or what we actually did. So when we find a difference, it helps us to gauge whether we are on the right track or not. So it says managers need to understand what they should be trying to achieve. A sense of purpose and direction is provided by what the plans or the budgets that we prepare. And for each plan, there are basically what activities or sorry objectives and performance targets that are set. Managers also need to know whether they are successful, and the information they need is provided by what comparing the actual results or performance with what the performance target. Okay, so when you hear target, plan, they are basically what the budget we are talking about. And by comparing what the performance target with current forecast of what performance will be. So once we are able to understand what the differences have been, okay, going forward, right, into the new period, how do we ensure that we sustain that performance? Okay, and that is also another aspect of performance evaluation. Hey, I don't have to be admitting anybody. Please join using the link that I shared with you, and try and ensure that the email account that you are logged in is the one that you provided during the registration, so that I don't have to admit anybody. Okay. All right. So on a very basic level, how costing or cost accounting helps us in the aspects when it comes to management accounting, which is planning, controlling, decision making. All right. Again, going back to the very foundational stuff, we need to understand what we mean by cost. So this is costing. Okay. Very elementary stuff. Costing, or our ability to analyze cost, is very important when it comes to your MA paper. We need to know what we mean by a cost unit, a cost center, and possibly what we mean by a cost card. These are basic stuff. A cost unit is a unit of a product or service in relation to which costs are ascertained. So that shoe that we are producing as a company, if we are a manufacturing company, or the service that we are rendering, right? If we are a service-based company, could classify or could be defined as a cost unit. So if we are a hotel, the rooms that we are putting up for people to come and rent, okay, for that short stay, for that short period, is what we call what a cost unit. If we manufacture paints, a liter of the paint or a bucket of the paint, right, is a cost unit. If it's a hospital that we are running, the patients in there can be classified as what? As the cost unit. Okay, so those are basically the issues. Now, what is a cost center? We say a cost center is a production or service location. Okay, it could be either of any of these. A function within the organization, an activity. Okay, and this is very important because when we get to ABC, you get to understand why that is so. An activity or an item of equipment for which cost can be what? Ascertained. An example could be a department within a company, a machine that we are using for our production, right? Within that machine, we may have or we will have what? Cost units in there, right? Because the machine we are referring to here is basically a whole setup, okay? a whole setup. So if you've been to a typical manufacturing concern, you're clearly going to understand how the whole setup is, right? A project that we want to undertake, within the project, we have what different cost units. And if it's a hospital, we are looking at a ward within the hospital. So we may have children's ward, female ward, male ward, emergency, all of those things, right? Within a ward, we are going to find what the patients who will be classified or defined as what the cost unit. Okay, all right. So you need to just have an idea of this thing. Also, very importantly, for you to have at the back of your mind is this thing we call a cost card or a cost sheet, right? Now, what is the cost card? A cost card or a cost sheet, when it comes to costing, right, is just a paper. Let me put it that way, just to um, give it to you in an image form. It's more or less like a form, right, or a paper, which is used to show the breakdown of costs or the cost of producing output based on the classification of each cost. So something new for you to look at here. Classification of cost. We'll learn that very soon. The cost card just says that if I'm producing a shirt, or I'm producing a liter of paint, or I'm producing a shoe, or a chair, or a table, whatever it will be, that sheet gives me a breakdown of what goes into the production of what that particular shoe, or that chair, or whatever the product will be. So it is the breakdown of the costs, and we'll later learn to know what those costs are. The cost card can be produced for one unit. So typically, if you see a cost card given to you in the exam, what the examiner tries to do is that the cost card will be for producing just one product. Okay, the company produces so many products, or they may produce tons of products, but the cost card will just tell you that, okay, for just one shoe, how much will they cost us? Okay, that's all. However, you could be giving me a cost card which will give you information with respect to what a plan level of production. So let's say this cost card that we have produced gives us an idea of how much it is going to cost us if we produce, let's say, 100 shoots, right, or 1,000 shoots, so on and so forth. But mostly, okay, mostly the cost card given to you is what the cost will be for producing one product. We are going to see examples of that very soon. All right. So what are these costs that we are talking about? Very quickly. We are saying if we are producing a product, then we will need materials. Okay. And for the materials, we are talking about the direct materials. We'll talk about what it is. We will need workers to work on the product. So how much is that going to cost us? That is direct labor. There will be other direct expenses incurred in producing the product. And these direct expenses are any other expenses which are not material or labor costs. And then we will have what we call overheads. Okay. And for the overheads, they are basically what we call the indirect expenses or the indirect costs. Okay. These are called indirect costs. So on the cost card, you are going to see what the direct costs and the indirect costs. The direct costs are also called prime costs. Okay, prime costs. So your cost card shows your prime costs and then your indirect costs. For the indirect costs, we are saying they could be what? Variable or fixed. Okay, variable or fixed. We'll explain what variable means, what fixed means. So that is what typically you are going to see on the cost card. Now, the other thing you need to know is that this entire cost card shows our cost for what? Producing. So this is production production cost. Okay, production cost. Production cost. All right. Please, I hope you appreciate the breakdown I've given here. I did mention earlier that costs which is presented or which we present on the cost card are grouped based on what? On how the costs are classified or the classification of costs. So how can we view costs? Okay, or how can we view the costs that we attribute or can charge to a product we are producing or a service we are rendering? They are saying costs can be classified by their element. And to classify costs by their element, we are saying we need to determine whether the cost is a material cost, it is a labor cost, or a cost that is what relating to something else, which is an expense. So when we say the element of cost, we are saying cost is a material cost is a labor cost, and cost is what an expense. So what is a material cost? We are saying these are all costs of material purchase for our production or for what? Non-production activities. So here it is looking at all our costs, okay? All our costs. But when we are preparing the cost card, the material cost that we are interested in is what? The one for what? Production. I just want you to get the distinction between these things, okay? So here it says material cost can be what? Material, the cost for production, or material cost for production, and what? Material cost for what? Non-production activities. But the one that we are interested in, or the material cost we are interested in to be present on our cost card is what? The production material cost. Okay, production material cost. All right. What about labor? So labor cost refers to what? All staff costs relating to employees on the payroll of the organization. So whether those employees are directly involved in the products that we are producing or the service we are rendering, or that particular worker or those set of workers are not directly involved in what? Our production. Our labor cost in general we are talking of here is what? All staff costs. But the one that we show, or the labor cost that we show on our cost card, is the labor cost that involves paying workers who what? Are directly traced or can be directly traced to the products that we are producing or the service we are rendering. So just to give you an idea that even for our costs, we have those that relate to production and those that relate to what are non-production activities. Okay, all right. And then for our expenses, we are saying these are all other costs which are not material or what or labor costs. They will include rental costs, okay, telephone, that is if we use telephone services, you have to pay for that, okay, depreciation of equipment and all of these are what other expenses that we can look at. Some we can directly attribute to the product we are producing, some are non-production what expenses. Okay, all right. So this is just a broad view of what our costs could be. Right. Costs can be classified by their nature. So now, another set of grouping. I did mention earlier that we have our production costs, some which are direct, some which are indirect. Okay, all right. So what are the direct production costs, or what we call the prime cost? These are costs which can be directly identified within a specific cost unit or cost center. What are they? If we are a shirt manufacturer, right, or we produce garments, then for that shirt that we are producing, we are saying the direct materials or the direct material cost, which we can directly trace to that shirt, is the cloth, or what we call here as the yards of material. Okay, please, the material I'm talking about is the literal Ghanaian material that we talk about. If you are going to sew a cloth, you say, I'm going to buy material for the cloth. Yes. So that yards of material, okay, quote unquote, you use in making the shirt is the direct material cost. Why? Because that material is what leads to the final shirt that we see. Okay, so it's a direct material cost. All right. Then we have direct labor cost. So that will include the wages of the workers stitching the cloth to make the shirt. So the people sitting behind the machine, they are directly involved in what? In making the shirt. So how much we pay them, okay? How much we pay them for the work that they are doing is the direct labor cost. Then the direct expense in this particular example we are using will be the royalties we pay to a designer. So the designer designs or sketches how they want the shirt or the particular final piece to look like. Okay, so anything or royalties we pay to such a designer will be what? The direct expense. So you can see that all of these costs we can directly trace to the shirts that we are making. And together we call these what? The prime cost. Okay. All right. And that will also mean that we may have other indirect costs. Now, please pay your attention. These are what? Indirect production. Okay. Indirect production. So indirect cost doesn't mean that it does not relate to our production. No. For all our costs, we have those that relate to production and those that are non-production costs. I just want you to get that. Okay. So indirect production costs are what we call our overheads. Okay. Even our indirect non-production costs are also called overheads. But we are interested in the ones that are related to our production. All right. So indirect costs are costs which cannot be directly identified to a specific cost unit or cost center. So to the example we're looking at, if we are producing a shirt, then the indirect material cost here will be, for example, the cleaning fluid for cleaning what? The sewing machines, for example. Okay. Now, this cost will form part of our general material cost, right? Aside buying the yards of the materials we need to prepare or produce the shirt, there are other materials that we'll have to buy. So cleaning fluid for the machine, right? Or any other material cost needed for maintenance. So the indirect component is what we have here. Now, this material is not used directly in what? In the making of the shirt. So that's what we mean. Okay. Then we have indirect labor. So that will include the wages of a supervisor who supervises what? The shirt makers. So that supervisor doesn't sit behind the machine to make the cloth. They supervise. They are our workers. And so if we are looking at our total labor cost, like I mentioned earlier, the wages we pay them will also be included. So that is an example of an indirect labor cost. Indirect expense. So that will include here the cost of renting the factory space where the shirts are manufactured. Okay. All right. And so all of these basically when summed up, will give us our production overheads. Okay, our production overheads, which we said could either be variable or fixed production overheads. So when you add the prime costs and then the production overheads, we get what we call our total production cost. Okay, so what I showed you here, at the end of the day, we have our production cost. All right. Now we have non-production overheads. So these are indirect costs that do not relate to our production in any way or form. And what are some of these costs? We have administrative costs, okay, and this involves the cost of what? Running the general administration department of the organization. So admin expenses, as we call it. Selling costs, or what we term as selling and distribution, right? So these two, they are all non-production overhead. So selling costs will refer to costs associated with taking orders from customers who wish to buy the company's what products and what also other marketing costs. So all of these costs are basically after production, okay, and they do not relate to the actual production. Distribution, the cost involved in distributing an organization's product to its customers, right? And then finance costs, that is the cost that we incur in order to what? Raise capital to finance the operations of what? Of the organization. So the cost we incur in raising capital, for example, the finance or the interest we pay, is what we are talking about here. Now, when you sum up all of these non-production costs and you add it to the production costs, which includes the prime cost, right? The prime cost, and then the production overheads, then you are going to get what? Your total cost as an organization. Your total cost as an organization. When you deduct this total cost from your revenue, then you can arrive at what? At your profit. I hope that is clear. All right. So please, in the questions we will be solving, when a specific type of cost is mentioned, you should be able to tell whether, oh, this is a direct cost, this is an indirect cost, right? Or whether the cost relates to your production or whether the cost does not relate to your production. That is the whole import of what we are doing right now. Okay. All right. Are there any questions on what we have done so far? All right. Very well. Still on the classification of costs, we are saying we can classify costs by what we call behavior, the way cost behaves. So there's a way that cost will behave, which if you are able to know, you can say, oh, this cost is either a variable cost, this cost is either a fixed cost, this cost is either a step fixed cost, or this cost is what we call a semi-variable cost. So let's look at the attributes of cost, which will help us classify it under what? All of these types. So variable costs, we are saying are costs that will vary in direct proportion with the level of activity. So a key term here, level of activity. Now, the level of activity here refers to the volume of production in the company. So how much products have we envisaged to produce? That is the level of activity. The level of activity could also refer to the volume of sales. How much products have we envisaged or do we envisage to sell? Okay, that's the level of activity. It could also refer to the total labor hours that we expect to use to be able to produce our goods. Okay, that is also a level of activity. It could also refer to the total time on the machine we want to spend in producing our goods. That is also what a level of activity. So we are saying there is a type of cost that varies in direct proportion to the level of activity. So if production increases, we are saying then this particular cost will change in direct proportion to the increase in our level of production. If our production levels falls, this cost will vary in the same breath. If sales increases, this cost might increase. If sales falls, this cost might fall. If the time our workers would take to produce is increasing, then this cost will also what? Change accordingly. That is what we mean, okay, by a variable cost. So as activity levels increase, then we expect that, again, another thing here you need to note, the total, okay, the total of the variable cost will increase or will decrease. That's vice versa. I hope that is clear. All right. So when it comes to variable cost, one thing is that it is the total variable cost that changes. However, we have what we call the variable cost per unit. So let's go back to our basic maths, okay? Total variable cost is equal to what? Our activity level times what we call what? The variable cost per unit. Okay, variable cost per unit. All right, so what did we say? We said if this is to increase, it means that this activity level is what? Is increasing. Mathematically represented, right? This will remain the same. This is a constant. If this cost, total variable cost here, is to fall, then what we are saying is that it should have been triggered by what? A fall in our activity level. Also with that, this is still what? A constant. So the variable cost per unit, please, this is one of the key characteristics of a variable cost, is going to remain constant. The per unit cost remains constant. However, it is the total, okay, which changes as the activity level changes. Please, I hope this is clear. Right. And so based on this attribute of cost, we are saying it is very usual to assume that all variable costs are marginal costs. Okay, so the definition of either a marginal cost or a marginal revenue is that is that extra cost or that extra revenue we are going to get when we produce that extra product, okay, or we sell that extra product. That is what marginal cost or marginal revenue basically means. So if you get to understand the definition of a marginal cost or marginal revenue in this context, marginal cost, it means if we produce that extra product, what is that extra cost we are incurring? And that basically is what variable cost also seeks to explain. I hope that is clear. So when you hear marginal cost, you can liken it towards a variable cost. I hope this is clear. All right. Then we have another cost that behaves in a certain way. This is what we call a fixed cost or a period cost. Let's look at the definition very well. It says a fixed cost is a cost which remains constant in a given period of time, regardless of the level of output or what? Or activity. So there's a certain cost. When you produce one product, the cost remains the same. When you produce 100 products, that cost remains the same. When you produce 1,000 products, okay, that cost remains the same. When you see something like that, then we are saying that cost you are seeing is what we call a fixed cost. But the other side of the definition you need to get is that it is going to remain the same in a given period of time. Okay? And so in economics, you'll be told that even fixed costs will become variable in the long term or in the long run. Right? So there's a time period attached to what? Fixed costs. That is also another one thing you need to get. All right. And so that brings us to another type of fixed cost, which we call the step fixed cost. We are saying this type of fixed cost is a cost that will remain only fixed within certain levels of activity. Okay? Or within a certain level of output. Once an upper limit of activity or output is reached, then a new higher level of fixed cost becomes what? Relevant for our operations. So if we are producing, or let's say the target set is that if you are producing between 1 to 100,000 products, right? Let's say, for example, we are saying our fixed cost will be, let's say, 20,000 Ghana cedis. This is the relevant range. However, if we produce one additional product to this 100,000, that is 100,001, okay, or 150,000 products, whatever it will be, we are saying once we cross this upper limit of volume, then our fixed cost is going to change from 20,000 to something else. So typically what you see is that they'll give you what we call that step increase in what? In your fixed cost. So anything outside of 100,000, we are saying an extra, let's say, an extra 2,000 Ghana cedis will be what? Will be included in our fixed cost. So what that will mean is that if you are producing from, let's say, 100,001 to, let's say, 200,000, right? Then our fixed cost will be what? 22,000 Ghana cedis. So a new level of fixed cost what has been reached within this range. I hope that is clear. So this is also a type of what cost that we have. We call it a step fixed cost. All right. So an example is the wages we pay a supervisor. If his span of control or the number of workers he's supervising tends to increase, then it means that we'll have to pay what? The supervisor more. Remember, salaries, I should have mentioned earlier, is an example of a cost that we term as what? Fixed. Because where you work, I'm sure you are paid what? The same salary, regardless of what? Your output. Okay? Unless maybe at your workplace, when you don't perform well, they reduce your salary. But in practice, we know that you are paid the same salary, regardless of your output within a given month. Okay? So, same thing, the wages we pay the supervisor, that wage will increase by an amount if the number of workers he's going to supervise will also increases. And then that becomes the new normal until he's giving what? A much more wider number of what? Workers to supervise. So that's what a step fixed cost. Okay. All right. Then we have what we call semi-variable cost. Now, that basically says that if you look at that cost, it will contain both fixed and variable what? Cost elements. So we've learned what variable cost means. So it says that if you see the cost, it has a portion of it which will change as activity level changes. And then if you know what we've defined as a fixed cost, it also means that it will have a portion which will remain the same regardless of what the activity level. So we are saying this type of cost is partly affected by changes in activity level. So that's the variable component. And then we also have the fixed component which doesn't change. An example is electricity bills. So in this day, we don't have that particular one, but those old meters we had, right? There's a standard charge, and then you have what? An extra charge for any additional units that you consume. So that is why your light bill may be different from another person's bill. It all depends on what your level of consumption. I hope that is clear. But there's a standard charge that is being charged across board or across the board, and then for every extra unit that you use, you are charged accordingly. Okay, so that type of cost is what we call a semi-variable cost. Please, I hope this is clear. All right. It is important that you understand some of these things, because when we get to other areas of the syllabus, I will call on you to remember some of these things so that we can make headway with those topics. All right. Now let's get into some very important stuff. And this is under the planning theme, okay, the planning theme of our syllabus. Even before we start the production cycle or we start the year, we have to plan for what our revenue and we have to plan for our costs. How much are we going to incur, right, to produce our goods? And then how much do we envisage to get from selling those products that we are going to produce? One of the key costs we have to plan is what we call our overhead. Now, we have to plan for our overhead because, like we've earlier explained, these costs are costs, right, that cannot be directly traced to our production. Or these costs are costs that do not even relate to our production at all. And so, how do we ensure that the right amount of these costs are charged to our product? The reason why this is important is because when it comes to the direct cost, I know that if I want to produce 10 shirts, let me use the example that we had earlier. There's a required amount of materials or yards of materials that I will need to be able to achieve that. Okay, so I know that, okay, if 1 yard is 10 cedis and I'll need, let's say, 10 yards, right? I'll need 10 yards. Then I know that my costs for producing the 10 shirts will be what? Will be 100 cedis in terms of the material. So I know exactly what my cost will be. When it comes to the workers, how many workers do we need to be able to produce the 10 shirts? And how much are they going to charge us? That is something that we can reliably estimate. Okay? And charge to our product. When I say charge, I mean add up to the cost of our product. However, when it comes to the overheads, especially those that do not relate to our production, we are saying these are also very important costs that we incur in getting to the final destination, which is what? Producing the goods and what? And selling to our customers to make money. And so the problem is, how much of those costs should we include into the cost of our product? How much of it? Okay, and we are saying the way we do that, or the way we absorb these overheads, can be done on a number of bases. Okay, so this is what we call the basis of absorption. I hope that is clear. So we are saying once overheads are allocated, and what we mean by overhead allocation, apportionment, and reapportionment is, you see, these are level 1 stuff. We need to take a note of our overheads that we are incurring in our production, right? And we have to classify them. Once we classify them, we apportion them, okay, or allocate them to what we call cost centers. And once they are in those cost centers, we absorb them. So absorption of overheads it's like the last thing we do when it comes to attributing our indirect costs into our product. I hope that is clear. All right. So after you have done the allocation, the classification of the overheads, allocating or apportioning them towards the right cost centers, the next thing you have to do is to absorb them. Okay. And so the key question is, how do we absorb these overheads into the products that we are producing? Or how do we charge the right amount of these overhead costs into the products we are producing? The basis of absorption are as follows. We can use the volume of production, okay, or the units we are producing, or the production units. So units produced or production units or demand right? Or volume. Volume of production, right? However you see it, we are saying we can use this as a basis to what? Absorb our overheads. Two, we can use machine hours. And this is typically when, for the type of company we are, or for the type of products that we produce, we use more of what? Machines. Okay? Or we have an automated setup. In that case, machine hours will be what? The appropriate basis for absorbing our overheads. Or we can use labor hours if our production is labor intensive. So we use more of what? Manpower. Okay? We use more of manpower to produce our products. Then the appropriate basis for absorbing the overheads will be what? The labor hours. And then we also have what we call the percentage of direct labor costs. And I hope you saw something like this in your paper last night, right? It is a basis for absorbing our overheads. Okay? A percentage of our direct labor cost. And we also have what? The percentage of what? Our direct material cost. Now, for the first three, there is a similar way we calculate this overhead, or what we call the overhead absorption rate, right? The overhead absorption rate is what we use to what? Allocate, or sorry, absorb the right amount of overhead into the product we are producing. So a rate is used to what? Do that. For the first three, the way we calculate this rate, or what we call the OAR, is looking at the budgeted production overhead, right? And dividing that by what we call the total absorption basis. I am saying total absorption basis because we've learned that the absorption basis could be what? Production units, right? It could be what? Machine hours, or it could be what? The labor hours. Okay? So if for you, your company has a policy to absorb your overheads based on production units, then the formula to calculate the OAR will be what? The total budgeted production overhead divided by what? The total budgeted what? Production units. Okay, so the formula will change based on what? The company's absorption or basis of absorption. If for you, the basis of absorption is to use the machine hours, then in calculating your OAR, it will be the total budgeted production overhead over what? The total budgeted machine hours. If for you, it is the labor hours, the formula will also be what? The total budgeted production overhead over the total budgeted what? Labor hours. That is how you compute the OAR. All right. However, for the last two, it is a percentage which we need to calculate. Okay. So the formula for that is very straightforward. Here, please look, it is the total, or what we have here, the numerator, the total budgeted production overhead, right, over the total budgeted direct labor cost or material cost. Right? So it's a percentage, so we'll say by 100. Now, what this does basically is to say, okay, if I take my total labor cost or my total material cost, I expect to incur in my production, how much of it, or how much of my production overhead can I find, sorry, in my what? In my total labor cost? Or how much of my overheads can I find in what? My total material cost? That is basically. So at the end of the day, you have to what? Get a percentage. And this percentage is what you are going to use to what? Absorb the right amount of overheads into the products that you are producing. Okay, so for the first three, the way we calculate the OAR to absorb the right amount of overheads is what we have here. But for the final two, which is the percentage of the direct labor hour cost and the percentage of the direct material cost, this is how you go about it. Okay, so the only difference is that for the last two, you see that you're going to use the total direct labor cost or what? The total direct material cost. Okay, all right. So what we've done above is just to learn how to calculate the OER, okay, which is the basis for absorbing our overheads. All right. But we are saying that for many companies, a product that they are producing may pass through more than one production process, okay, or pass through more than one cost center. And so sometimes you may have to calculate an OER for a specific cost center, or if it is the organization's policy, they may calculate an OER that will cover what? Their entire production process. I hope that is clear. So let's get to understand this. The OER is used to what? Charge the right amount of overheads into the product we are producing. And the basis for doing that are what we have outlined. What we are saying again is that if the company's production is broken down into stages, we can be able to what? Absorb this overhead within each stage of our production. Or if we like, we can what? Absorb our overhead based on what? Our entire production process. So that is basically what this means. All right. Any question, please? Any question, please? On the basis of absorption that we have. Any question?